Dividend investing is getting really popular. If you Google it or YouTube it, you're bound to find tons of material. Should you be jumping on the bandwagon?
Alright guys, welcome back to the channel, the best place for long-term stock investors. MJ here.
John here.
Now in this video, you're gonna learn about what is dividend investing, and of course, more importantly, what are dividends, right? Why are they important?
That's right.
Then you're gonna learn why you should do dividend investing, and then why you should not do dividend investing. And then lastly, if you stay until the end of the video, we'll tell you exactly what we think and whether or not you should do it.
So guys, we love producing this content for you guys. Hit the subscribe button, give this video a like, and hit that notification bell so that you know the next video is out for you.
Alright, so let's take a look at what dividend investing, and before that, what are dividends actually? So if you haven't already know or haven't watched this video of ours, we explained in this video that a stock is essentially a business. So how does dividends relate to this? Now, imagine a dividend as cash that you receive as a shareholder. But the question is, how did you receive that cash? Where did that cash come from? And the answer is very simple. You see, every business has a product to sell and a service to sell. Or at least I hope so, right? And when they sell that, they get money.
Yep.
Now, if over time they generate profit, then the CEO or the owner of the company has a right to pay out that profit in cash form as dividends. And that's, in a nutshell, what dividends are.
It didn't just fall out of the sky, guys.
Now, why is dividend investing so popular, and what is dividend investing? Put simply, dividend investors just like to buy companies or stocks that keep paying them dividends, right? And John will go into more detail later on, but essentially they like the cash flow every month. Think of it like a house rental, right? These are the kind of investors that are attracted to dividend investing. Now, because there's this sort of cash flow coming in every month, and usually they're pretty consistent, a lot of dividend investors become dividend investors because there's some sort of stability associated with it, right? And you always hear terms like them buying blue chip stocks.
Yeah.
So if you're in Malaysia, and if you can actually Google yourself some of the Malaysian dividend investors, right? They always have companies like Maybank, Public Bank, Tenaga, company Scientex, companies like that have a history of paying pretty good dividends. And another thing that they really like is dividend yields. We're gonna go a lot deeper later in the video, so stay tuned.
Yep.
And so because they buy these blue chip stocks, so it gives them the impression, or the hope at least, that their stock portfolio, which usually can be very volatile, is a little bit less volatile and is more stress-free. But again, more on why you should become a dividend investor in the next section.
Yeah. Now, here are the reasons if you want to be a dividend investor. Regular passive income. Now, what do I mean by that? There's this sort of stocks on any market in the world called REITs, or real estate investment trusts, and it's very popular among dividend investors because they pay the dividends on a quarterly basis. So can you imagine if you buy multiple REITs and you want dividend in January and then February, you just stagger them out. And I know people who actually do that so that they get dividends every month. Regular passive income.
And the thing I'll add also is that they're always looking for this thing called dividend yield.
Oh yeah.
Right? So for example, if they put in 100,000, let's say a dividend yield of 3%, they'll get 3,000.
Yeah.
Right? So, and the REITs that John talked about, they're not at 3%, they're usually at 5 to 6%.
That's right.
Again, 100,000 means they're getting 5 to 6,000 a year in dividends.
The second reason why you could be a dividend investor is because of consistency and reliability. Now, what do I mean by that? Companies that are able to pay dividends on a long-term basis usually bring some sort of sustainability and confidence in their earnings. Because can you imagine if you're a CEO of a company and you know that you've got to pay that dividend next year, right? You better be sure you're gonna have confidence in bringing in that earnings next year.
Yeah, because you made a promise in a public assembly.
Correct.
And then John will talk a little bit more about payout ratios later, but essentially, all of these companies have a commitment to pay out X percentage, 30%, 20%, whatever it is, and they'll publicly say it, so you're almost guaranteed to get it as a shareholder.
Dividend guidelines. The next reason why you could be a dividend investor is because of management and shareholder alignment. Now, what do I mean by that? You can see some companies, right? The moment they make a lot of earnings, the CEOs and the board of directors pay themselves handsomely, but distribute none of that income to the shareholders. Would you like to invest in a company like this? I'm pretty sure you won't, right? And this is where the dividend payout ratio actually comes into play. What we mean by that is that you look at the earnings of a company against the entire dividend pot that this company is paying to you as a shareholder. So if the company makes 100 million and pays you 80 million, that means that's 80% of the earnings paid to you as a shareholder. Then you know that the management and the shareholders are in a way aligned. Obviously, not all companies are able to pay 100% because they have to retain some of their earnings to grow the business. But a good high payout ratio gives you a sense that the management wants to share the company's wealth with you as a shareholder.
Yes, so they are rewarding you by rewarding themselves.
That's right.
And usually companies with high and consistent dividend payouts have management that actually own a lot of the company. So one that comes to mind is Nestle Berhad.
That's right.
They own, I believe, 70% of the entire company, Nestle Switzerland.
Yes.
And so when they pay you a lot of dividends, and I know a lot of long-term Nestle shareholders are very happy.
Yeah.
Essentially, they're paying out a lot because they're also receiving a lot. And you get benefited as a side.
Skin in the game. The next reason why you could be a dividend investor is because when you buy into a company that has consistent dividends, this company has the strength of internal cash flow generation. Now, what do I mean by that? Like for Nestle, as MJ mentioned earlier, they consistently pay out a very high dividend ratio, usually in the 100%. And they have the ability to do that is because they are very confident on the cash flow generation of the company. That they will replenish their coffers enough to pay dividend consistently. So when you buy into a company like this, their cash flow generation is pretty solid most of the time.
Yes, and you know, we go very deep about this thing called free cash flow in our coaching program, right? Which, by the way, if you want to apply, link is in the description. But essentially, a company that can have what John said, strong internal cash flow generation or more, is usually a company that does not require a lot of reinvestment.
That's right.
So imagine as a shareholder, do you want a company that has to reinvest a lot just to sustain the business? Or do you want where you don't need to reinvest anything, but yet the cash flow can grow? So I think for most people, the one that does not require reinvestment is the better option. And usually companies that pay good dividends are in that category. Okay, so what are some of the reasons you should not be a dividend investor? And I think this is something you should sit in, because the impression I always get online and talking to people that mention to me about dividend investing is that it's very risk-free or low risk, right? And I actually think that is not true. Because at the end of the day, investing is investing. It doesn't matter whether it's dividend, growth, value, whatever investing you talk about, right? Essentially, investing is investing, and there are risks inherent in all investing strategies. And so I'm going to explain to you why you should be wary and be careful of dividend investing. Okay, the first reason why you should be careful of dividend investing is because if the company is able to pay you so much dividends year on year, this might be a sign of what we call maturity. In other words, management sees that, hey, the industry that I'm in, let's call it the cigarette industry, the newspaper industry, is not growing anymore. So I can't reinvest into it, and so I have to pay out. So you might feel a little bit of relief or happiness whenever you get that big chunk of dividend, maybe a dividend yield of 7% or 8%, right? And this is very common among, if you know BAT or the Star, they have very high dividend yields. You might be happy for a while, but what ends up happening, and you have to remember this, in order to get a dividend, you need to buy the stock, right? And then you need to buy the stock at a particular share price. There's a very good chance when the company is really mature that the share price won't be moving. And if you're not careful to understand the business, the share price might actually fall quite a bit. So while you might gain in dividends, you actually lose out in the share price, and net, you won't make any money. And I assume that is your goal, right? To make money.
Correct.
The next reason you should avoid dividend investing is because sometimes we have what we call one-off items in the profit and loss statement.
Special conditions.
Correct. So what ends up happening is sometimes, so take for example AirAsia, I think in 2018, they paid a lot of dividend and their dividend yield went up to like 20 to 30%. It was crazy, I still remember at that
90
time.
cents dividend that time.
Yeah, the share price was like 250, 270, and then they paid a 90-cent dividend. So if you do the math, that's like 33%. That's massive, right? And so what happened is that this actually drew the attention a lot from a lot of dividend investors, and they suddenly said, hey, AirAsia is now a dividend stock.
Yeah.
Now what happened was that actually AirAsia sold a bunch of planes, and so they got a bunch of cash now in their bank, and they decide to pay that off.
Yeah.
Now if you think about it, do you think AirAsia will sell tens or hundreds of planes every year? They won't, right? And what this means is that whatever profit they get or the proceeds of the disposal of those planes is only going to be a one-off.
Yeah.
But because of that one-off, it made the profit look good and made the dividend look good. And so that might trick you into thinking, hey, now this is a dividend stock.
Yes.
Now, of course, with COVID, we all know AirAsia is not doing so well. And so a lot of people bought in 2018 thinking that AirAsia is a dividend stock. They're not so happy now.
Yeah.
So that's one thing that you really need to take note of, that because dividends are counted in the profit and loss, so it can be manipulated. And that's really only on the income side, right? What about expenses? Maybe they're a one-off expense that made the profit look very small. And so you think that the dividends paid that year wasn't so high, but actually it was a bit misleading.
Yeah.
So one-off, you need to take care of that.
Especially in cyclical industries, because when you have cyclical industries and they need to dispose of assets, that's where a lot of these scenarios like what MJ described happens actually.
Correct. So I think back to the first reason as well, you need to understand the business, right?
Yeah.
Avoid one-offs. Okay, the third reason you can or should avoid dividend investing is this thing called consistency bias. Remember earlier on I talked about how management of companies like to promise you a certain dividend policy. So the standard one I always hear is, hey, we are willing to pay out 40 or 30% of our profit in terms of dividends. Now the thing is, when it comes to business, things are not static and things can change, right?
Yeah.
So when management made that promise, it was based on what was happening back then.
Yeah.
But sometimes if business change for the worse, they actually should not be paying dividends, right? They need to retain money in the company to keep it afloat and to make sure it's doing fine even in a downturn. But where this consistency bias comes in is when, because the CEO has already publicly announced it, he's not going to want to take back his word, especially with people that have high integrity, which is ironic, right? They say, hey, I already promised 30-40%, so I have to pay that amount, when it might not be good. And at the end of the day, as a shareholder, you're investing into business, right? So you need to decide whether or not the dividend paid out is going to help the business or not. And of course, I think AirAsia is another prime example, right? If it had kept its dividends, maybe it wouldn't be struggling as much today. Now, this next one is very key, right? Which is about dividend yields.
Now it's different from dividend payout ratio, yields.
Yes, so I mean, essentially a dividend yield is, how much money you put in and how much are you getting back in the stock, right? You put in, let's say 100,000, your dividend yield, 7%, you're getting 7,000 back. This is very dangerous, I think, because again, in my experience, companies with high dividend yields are high for a reason.
Yeah.
Is because the share price has dropped a lot. So what happens is that sometimes share price can drop faster than your dividends.
Yes.
And when that happens, the dividend yields will look high.
Correct.
So maybe the dividend is really dropping, let's say at 10%, at a 10% rate every year, right? But the share price dropped 30% rate every year. So it's no surprise where you'll see companies, trading at a 6 to 7% dividend yield or more, that makes it look attractive to a lot of dividend investors, are actually struggling and are actually investments you should not be making. So one thing you really, really want to emphasize on is to never look at the dividend yield. Always look at how sustainable the dividend is.
Where's the next one? Are they able to pay the next one? That's
the next one, right?
Yeah.
And how do you know whether they can pay the next one? That's
Yeah.
where understanding the business is so important.
Yeah. So rather than go with the general perception. We're going to share with you our conclusion to dividend investing, and this is what works for us. May not necessarily work for you, but hear us out. We don't do dividend investing is because while dividends are important to us, it is not primarily the reason why we buy into that company, because it is just a form of capital allocation when you invest. If you're allocating money into a business that is supposed to grow for you, and yet they are paying you dividends but it's not growing, would that be something that you want to pursue? I don't think so. That's why capital allocation and understanding this concept of growing your wealth rather than just so focused on the dividend is not something for us.
True, and I would say that a lot of the dividend investors that I've spoken to are surprisingly more short-term.
Yeah.
And they're not short-term in terms of the share price, but they're short-term in the sense that they want the money right now.
Correct.
From the dividends.
Yes.
But the way money works, we have discovered is that whenever the company is good, especially, you should reinvest it. Like, not treat it as cash flow to go party and buy whatever house that you want. But that said, dividends is actually very important to us nevertheless.
Yes.
Because even though maybe it gives you 2%, 3% a year, if you reinvest it, and we did our own math, depending on your portfolio, it can actually contribute anywhere between 20% to 40% of your entire stock market returns.
That's sizable, guys.
Yes. And you have to think of dividends in a way that is like some sort of steroids.
Yeah.
Right? If you got a good stock and you put more into it, it's going to grow even more.
Yeah. And that's the point about when we hear this complaint a lot that you don't have enough money, you don't have enough money to put. Then what are you doing on your dividends? So, catch us on our next video, even in our coaching program where we show you how you can supercharge your portfolio using dividends as well.
Yeah, and I can assure you, if you are willing to sacrifice a good dividend yield, right, you are really going to see your portfolio grow a lot.
Yeah.
So that's why we do not consider ourselves dividend investors.
Yeah.
We are investors. We are investing in a business, right? And it's very contextual. It depends on, is a high dividend good, is bad, is low dividend bad? Well, it all depends. And that's why I urge you to focus more on the business, right? That's way more important.
Yeah. Is it a cyclical industry? Is it an industry that's going about to die soon? All those kind of things. That would mean more than just focusing, this yield is high. The yields change every year, right?
Yeah. So I know it seems like listening to us, we are pretty anti-dividend investing. And, well, we're not dividend investors, but perhaps this is the biggest reason why we still love dividends and why we just love them, It's because dividends is what we call proof of profit.
That's right.
Right? Sometimes when a company makes money, it can hide it from you. Maybe the numbers are fake. But one thing that is not fake is dividends, right? Because you actually receive the cash.
Yeah, cold hard
so that's
cash.
what proof of profit means, and that's probably the biggest reason you should be a dividend investor.
Yeah. So we hope you enjoyed this video and our take on dividend investing. We tend to differ a little bit from what is popular belief, and I think that suits us. So if you think that you could learn more, watch our other videos on this channel. Remember to follow us on Instagram and Facebook. Hit that subscribe button, smash that like button for me, and we'll see you in the next video.